2022 has been a challenging year for financial assets so far, as the markets have been confronted with risks posed by inflation, tightening monetary policy, and geopolitics. Major equity indices have fallen into bear markets, while fixed income has suffered by far the worst start to any year on record. In the first half of the year, Asian dollar credit was down by 10.7%, while Asian local currency bonds were down by 9.1% in US dollar terms. Overall, the Asian fixed income market did not perform as poorly as global bonds, which were down by close to 14% in US dollar terms. As in the sharp market declines in the past, we think the recent price action has reset valuations to levels that are attractive to investors for the longer term. One obvious reason is that the likelihood of a US recession has been rising as both the financial assets and real economy are getting squeezed by tighter financial conditions. Now, if you look at the previous slowdown phases, bonds have typically started to perform well when investors adjust to a weaker growth outlook. And if the US Federal Reserve succeeds in putting inflation in check, which is our base case, we think it would create an even stronger backdrop for bonds. In our Asian macro strategies, we have been tactically managing our active duration exposure, focusing on relative value trades. We favor countries where the central banks have started their rate hike cycles earlier, such as Singapore and South Korea, where we see better value. We also continue to like China, as the monetary policy there should remain accommodative given weakening growth momentum. As for currencies, we continue to overweight the US dollar, renminbi, Singapore dollar, and Malaysian ringgit, funded by underweights in the Taiwanese dollar, Hong Kong dollar, and euro. In our Asian credit strategies, we have been defensive and trimming the overall credit beta given macro uncertainties and rising idiosyncratic risk within the China property sector. With the market pricing in a significant amount of rate hikes and negative news, we think the all-in yields look attractive, especially for Asia investment-grade credit. As for high yield, we continue to stay cautious and highly selective within the China property sector while seeking opportunities beyond, such as Indian renewable energy and infrastructure, as well as selected commodity names. To conclude, in the current market environment, we suggest investors to focus more on the diversification benefits from fixed income instead of trying to pick the peak in yields. Especially during periods of elevated volatility, investors should take a long-term view of financial markets in order to cut through the noises and prepare for the opportunities that may lie ahead.
Investment involves risk. Please read the relevant offering documents before investing.